Should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Don't move your money from Bear. That's just being silly. Don't be silly.
And then in the middle of the night, we got an email.
A text.
That the firm had filed for bankruptcy.
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 It's bankruptcy.
Top 10 cognitive biases that cause investment mistakes. Understand that investing in the markets is just as much psychological as it is analytical. You could have done all the right research on a stock, but if you succumb to one of these cognitive biases, it dramatically increases the probability of you making a mistake and losing out the gains of that opportunity, or worse, incurring a loss. To become a successful investor, you need to overcome these biases that lead to poor investment decisions. This can be tricky because many of these psychological biases are hardwired and programmed into our brains, so overcoming them requires a conscious mental effort. Taking the time to understand these biases gives you a better chance of identifying them before they impede your investment decisions. So when listening to this list, ask yourself if any one of these might have caused you to make a biased decision. And going forward, take care to identify not just for yourself, but also for any financial information that you read or watch online to see if you can identify any of these biases present in that work. With that being said, let's start off the list at number 10, which is anchoring bias. Anchoring bias is the tendency to rely too heavily on a piece of past information, hence the term anchoring, when making a decision. In the context of investing, it's common for investors to display this anchoring bias, particularly when it comes to recent stock prices or their cost basis on a stock. Some people might base their investment decisions based on where the share price is relative to recent trading history. However, it should be noted that from a fundamental level, the past share price is irrelevant when it comes to determining whether the stock is expensive or cheap. This bias is particularly hard to avoid because whenever we enter a position, we automatically set up an anchor point with our cost basis. This is the average price at which we bought our shares and is the key determinant of what our returns will be in the future for that stock. However, with the exception of tax reporting, that cost basis then has no more relevance going forward in your decision of whether you should continue holding or selling these shares of your stock. You need to make that decision independently of your cost basis, otherwise that induces anchoring bias. How you can avoid anchoring bias is by looking at each stock objectively and independently and ask yourself, regardless of whether you've owned shares in the past, do you think the stock is undervalued or overvalued at its current price? When framing the question objectively, it makes it a little easier to avoid being concerned with past prices. And cognitive bias number 9 is neglect of probability. This is the habit that we have of either ignoring or over or underestimating probabilities in decision making. When investing, we might imagine what is the most likely scenario for a company going forward. However, it's important to keep in mind that this is simply one possible scenario for the company in the future, and in reality, there's a wide spectrum of possibilities that could impact both the performance of the company and your investment returns. Now, some companies that are more stable might have a smaller range of possibilities. Think, for instance, like utilities and some consumer staple stocks like Coca-Cola or Procter & Gamble. However, there are also stocks that have a much wider range of potential outcomes, some of which come to mind are the current FANG technology stocks. Another example of neglect of probability is our underestimation or simply deciding to be ignorant of the possibility of tail-end risks, sometimes called black swan events. One of the most common and cliched responses in comments that I sometimes see, in particular regarding a market crash, is that the stock market will never go to zero, and if it does, we'll have a lot bigger problems to face. Which, if you get down to the core of this message, is that they have no protection against tail-end risks and low probability events. This is exactly what happened to many volatility traders in early February 2018, when inverse volatility products like VIX collapsed over 90% in a single day. Remember, being ignorant of risks doesn't make them go away. And the 8th cognitive bias is called restraint bias. This is our tendency to overestimate our ability to show restraint in the face of temptation. In the context of investing, this can mean that it's very tempting for us to continue investing more in what we believe are our best investment opportunities. Now, while this doesn't seem like a bad thing at first, it can easily get out of hand if you're not conscious of it. On one hand, if you see an investment that you've made do really well, you might be tempted to put more money into that investment, hoping that those gains continue to rise further. However, there's also the possibility that one of your investments has fallen and thus provides the temptation to add more money to that position in order to reduce your cost basis further. If one's not careful, this can lead to having a position too large for one's risk appetite within your portfolio. How you can avoid this is by, before even considering buying a stock, have an idea of the maximum amount of stock you want to have of that within your portfolio, and be careful and cautious not to exceed that limit. There is such a thing as too much of a good thing, which is what many of us, I'm sure, experienced on our first Halloween. The seventh cognitive bias is the bandwagon effect, also called groupthink. This bias leads us to have comfort in something because a large number of people do or think the same way as us. This bias can be particularly pernicious because it can give us a false sense of security when we have many people around us in the same boat. From an investment perspective, probably the largest example of this would be a lot of people jumping on the passive indexing investment bandwagon. That, combined with significant inflows into many of the large technology stocks, it seems like many people are on the same page in investing. However, it's important for investors to maintain independent and critical thinking and not to always go with the herd. Groupthink and herd mentality are some of the prime reasons for why we see many financial speculative bubbles, whether it's with dot-com stocks in 2000 or the cryptocurrency mania in 2017. The bandwagon effect is something you should look out for. As Robert Frost once said, 2 roads diverged in a wood, and I took the one less traveled by. And that has made all the difference. The sixth cognitive bias is hindsight bias. Hindsight bias is the tendency to look at past events and consider them more predictable than they actually were. This bias is extremely prevalent in investing and often is accompanied by small comments like, "Oh, I should have bought at X," or "I should have sold at Y." And you'll see many mainstream articles blatantly showing it off. Anytime you read an article about if you invested $1,000 in Amazon in 1997, this is how much you'd have, that's a clear example of hindsight bias. The only reason those articles are being written is because Amazon has performed so well. You don't see any articles about if I invested $1,000 in GoPro, here's how much I would have. Hindsight bias hurts investors because it prevents them from learning from their past investment mistakes. In its worst case, hindsight bias can leave investors thinking that every successful investment they've made was because of their keen judgment, even when it wasn't. And it can cause investors to chalk up losses simply to volatility and unpredictable events. One way to help reduce hindsight bias is to have a written thesis or investment idea for each investment that you consider taking. This would include why you think this investment is a good value, some of the risks of this investment, as well as your expected return. With this, you'll get a sense of exactly what you were thinking every time you made an investment decision. Cognitive bias number 5 is oversimplification. When trying to understand complex topics, we tend to desire simple explanations. However, in some cases, and sometimes particularly with investing, there are situations that are simply too complex or uncertain to boil down within a few simple arguments. I see this sometimes with investors investing into growth stocks who believe that past levels of strong growth should be able to be maintained indefinitely. However, this is a case of oversimplifying the environment the company was in when they had their fast growth, as well as the challenges they face continuing to grow at the same pace as a larger company. One way to mitigate the effect of this bias is to focus on investing within your circle of competence. These would be companies or industries that you know the best. For instance, I've spent a lot of time researching, analyzing, and investing in both retail and consumer goods companies. Because these are companies and industries that I understand relatively well, I'm able to make a more objective and informed business decision on whether or not I should invest in these companies and whether there's value at these prices. To avoid having this bias hurt you and your portfolio, you likely should avoid investing in industries where you don't feel you have a good understanding. Whether that's pharmaceutical companies or some technology companies, wait until you have a good understanding of both the industry and the business before you invest. The fourth cognitive bias is incentive-based bias. This bias covers the effects that rewards can have on human behavior and how they can oftentimes lead to poor long-term decisions. They say if you want to find the truth, follow the money, and that is oftentimes very true. In order to understand how people, including management, behave, you need only to take a look at their incentives. In this case, companies with management that are given lucrative stock options may be incentivized for more short-term results over long-term business performance. We saw this in particular with a company that I covered last month, Bed Bath & Beyond, which had a terrible share buyback program that destroyed shareholder value but enriched management through option payouts. Keep this in mind when you're investing in businesses on how the management is compensated. Ideally, look for compensation plans that are not too heavily skewed towards options and incentivize the management for both achieving long-term results but also avoiding downside risk. Having the right incentives in place helps ensure that management is working for you as the owner and shareholder. The third cognitive bias is loss aversion. This is the tendency for people to strongly prefer avoiding losses over achieving the same amount of gain. This is closely related to what's called the endowment effect, which is where someone places a higher value on a good that they own compared to the same good that they don't own. Loss aversion and the endowment effect combined can lead to a very strong bias and poor investment decisions when an investor refuses to sell an investment at a loss in hopes of trying to make that money back. You see this in the form of rationalized comments like, "It's not a loss until you sell." However, there are some investment decisions that were simply poor decisions, and you will have to recognize that loss eventually. By continuing to have your capital tied up in a poor investment, you're paying a significant opportunity cost, which is that you could be using that money to invest in a better investment opportunity if you finally decided to sell and recognize the loss. One way you can help mitigate the impact of loss aversion and the endowment effect is to keep a limited number of stocks in your portfolio and not to exceed that limit. This limit on the number of stocks will force you to only be investing in what you believe at that time are your best investment options. This will force you to cut your losses with investments that you no longer think are a good investment decision. In describing how investors could achieve superior returns, Warren Buffett once described an analogy of a punch card. In this case, the punch card only had room for 20 holes, and each time you made an investment in your lifetime, one of those holes would get punched. In Buffett's mind, this would force investors to think very hard about their investments, including the risks, that would likely lead to investors making more informed decisions. Cognitive bias number 2 is information bias. Now, information bias is the tendency to evaluate information even when it's useless when making a decision or understanding an issue. This is particularly prevalent in today's day and age where you have access to nearly unlimited information. However, the quality of some of that information is questionable, and the relevance for some is rather limited. Very little of the information that you read and consume is relevant to making an informed investment decision. It's your job as investors to hone your skills to discard and ignore any irrelevant information. Much of this irrelevant information comes from other people's opinions. Not everything that everyone says has value, so it'll be up to you to decide what should be used in order to make an informed investment decision. This includes also looking at daily stock prices. In a sense, daily stock price quotes are simply the market's day-to-day opinion on a stock and are really not that relevant for making long-term decisions. I would argue the majority of investors would be perfectly fine only looking at their stocks once a week or even just once a month. Rarely is there an opportunity you'd miss by not keeping up day to day with the market. For instance, following their recent earnings report, Facebook's price dropped to $170, which many investors thought was a very rare opportunity. However, since then, Facebook stock is now trading in the low 150s, so investors didn't need to keep up with stock market moves daily in order to capitalize on that potential opportunity. If you're able to tune out most of the noise, you'll be able to make sounder investment decisions. And the number one top cognitive bias is one that I see so much and is one of the most pernicious, is confirmation bias. Now, confirmation bias is the tendency for us to seek out or emphasize information that confirms an existing conclusion or belief that we have. This is probably the number one cause of investor mistakes because investors will get overconfident when they keep seeing information that confirms the beliefs that they already have. This is a particularly difficult bias to fight against because we naturally seek out information that we want to hear and avoid or reject information that goes against our current beliefs. This is a bias I want you to pay particular attention when you're listening to anyone on YouTube. If you hear phrases in absolute, like it's a sure thing, it's easy money, it's a guaranteed win, there's no doubt about it, these are all textbook signs of confirmation bias, giving full consideration to the information you want to hear and neglecting any opposing views. Confirmation bias is the reason why for hundreds of years people thought that the sun revolved around the earth, and why Galileo was persecuted for sharing an opposing point of view which actually was the truth. And if it wasn't difficult enough to fight against confirmation bias, technology makes it even harder. That's because media platforms like YouTube and Facebook have algorithms that actively promote cognitive bias. They want to show you content you'll be interested in watching and reading, much of which already supports your current views. In order to protect yourself against confirmation bias, you need to actively seek out information that discusses why you could potentially be wrong on an investment decision, not the other way around. Oftentimes, listening to people with opposing opinions can provide insight into some risks or considerations that you would not have had you only listened to information that you wanted to hear. This, at the end of the day, will help lead you to making more informed and better investment decisions. So there you have it, the top 10 cognitive biases that can cause investment mistakes. As a value investor myself, I often have some contrarian opinions, so if you're interested in an occasional opposing point of view, consider subscribing by clicking my face here. Until then, I'm interested in hearing about what you guys think about many of these biases, and if you've experienced them yourself or seen others investors do so. Until next time, my name's Michael, thank you for watching, and I will see you in the next video.